Tom and Charlotte. Good. So I'm going to hand over to you now, and you can tell us all about MIGO Opportunities. Thank you very much for doing this.
Great. Good morning, everybody. I'm just going to get us to the right slide. Thank you all for your time this morning, and thank you, James and Andrew. It's a really interesting half an hour on the trust world. Obviously, we love investment trusts, so it's always great to have a run through. We are going to talk to you today about the trust myself and Tom run, which is MIGO Opportunities Trust. And what we do is we invest in investment trusts on a discount. So now we've done the disclaimer slide, we can move on to a bit of an overview of MIGO. I'll talk about a little bit of an overview, talk about the sector in general, and then Tom is going to finish up talking about our portfolio and the themes and ideas that we think are very exciting at the moment. So MIGO is quite small, so it's great to hear that Andrew thinks that there's lots of opportunities in some of these smaller trusts. We agree. So MIGO is reasonably small, just under 17 million market cap. We have quite a concentrated top 10. So we're putting our money in our best ideas. It's currently around 63%. We do have a redemption opportunity every 3 years, which we think is very useful for investors, as they can get out of their entire holding every 3 years if they so wish. Thankfully, very few investors have chosen that option, but we certainly don't take that for granted. And something that we changed more recently was the management fee, which we've halved to 35 basis points, and included a performance fee, which is 15%, in excess of SONIA plus 3. And I think this really highlights that we really believe in this strategy, and we believe that we're very hopeful that there should be some good performance going forward. So what is it that we do, and how do we do it? So as I said at the beginning, we are investing in investment trusts and closed-end funds at a discount. We are therefore very value orientated. We tend to have lower correlation with mainstream indices, so if you are a bit more worried about the AI bubble, this might be something to have a look at. We are index agnostic, so we're just looking for the best ideas in the investment trust sector. As I said, we have increased the concentration in the portfolio so that there's more money in our best ideas. And we're looking for catalysts to narrow those discounts and to extract that value. So the process, we do very extensive research on our underlying holdings. This includes detailed models, IRR scenario analysis. We look at private transaction. That's very important, and I'll come on to a bit later why that's so important at the moment. And we use expert networks as well to really get under the lid of our investments. So how do we generate returns? There's sort of two ways that we do this. First of all, it can be that when we buy a trust on a discount, the discount comes in, either that trust comes back into popularity, performance picks up, and you can see on that graph, the illustrative graph on the top right, that discount narrows, and the net asset value goes up, and that's a nice combination for returns. What is happening more often, because we're seeing an awful lot of discounts in the investment trust sector at the moment, can be the end of the trust itself. So a trust going into wind down, and there's the graph on the bottom is sort of an illustration of that situation. So one of the big themes in the portfolio is this great unwind of investment trust discounts. And I'll talk a little bit about why we have such big discounts in a moment. But we've had an awful lot of issuance over the last 15 years. And we think that what's going on in the trust sector is actually quite healthy and quite normal, for the fact that you've come out of a considerable amount of issuance, and it's sort of cleanup phase of the trust sector. So what we are seeing is a huge amount of corporate activity happening, whether it's, and you can see here how many trusts in the sector are currently going through some of these mergers, acquisitions, delistings, strategic reviews, ongoing wind downs, and then proposed wind downs. And you can see that we've had examples of all of these trusts, all of these kinds of corporate activity in the trust over the past few years. And we think this is a really exciting way of extracting value from the opportunity set at the moment. So why are discounts so wide? Well, one of the reasons is higher interest rates. So, as you can see from the graph, a huge amount of issuance happened after 2008 when interest rates were very, very low. Investors were looking for yield, and a huge amount of investment trusts were launched in the alternative sector, which provided that yield for investors. If you fast forward to 2022, when interest rates have risen, investors moved back to those more traditional sources of income, and prices fell as the supply and demand fell out of equilibrium, and you had far more shares on offer than you had demand for. That's why discounts, particularly in the alternative sector, have gone very, very wide. Secondly, we've had a headwind of the ongoing charges, where investment trusts were caught up in some EU legislation, making particularly alternative trusts look very, very expensive. Again, that made it more difficult for investors to put it in their portfolio, as it made their portfolios look very expensive. And then finally, we've seen a considerable amount of consolidation in the wealth manager sector. Again, this is taking out demand for investment trusts, as if the wealth manager is getting bigger and bigger, they're struggling with the liquidity in the investment trust sector to be able to allocate across their clients. So it has been a tough period for investment trusts, and you can see how wide discounts have got across the piece. But actually, if you're looking for discount opportunities in the investment trust sector, it is a very exciting time to build a portfolio of really exciting assets where we think there'll be corporate activity in order to unlock that value. So one of the reasons, and I spoke about alternative assets and why we've moved the portfolio over to that, and I think this slide just really highlights the opportunity set and why we've reduced the equity exposure in MIGO. You can see that the average discount in equity trusts is now in single digits, whereas things like property, private equity, renewables, those discounts are still remain very, very wide. We also think that for an equity trust, if you run your portfolio through Bloomberg, you get a pretty fair value for what that portfolio is worth. In things like renewables, private equity, growth equity, understanding the valuation, the principles, the private transaction comparables, it can take a considerable amount of work to really get under the bonnet of valuations in this sector. So we also think that this is an area where we can be particularly value add. So that was a little run through of the trust, and I'll pass over to Tom, who's going to talk kind of the stock specifics and what we've been doing.
Thanks, Charlotte. So we have the top 10 holdings here as at the end of the third quarter, so end of September. I don't propose to go through each of these names in detail, but we're very open in the Q&A to answering particular questions on particular stocks. And the key points to bring out here are, one, the concentration Charlotte referred to earlier on. As it ends September, we had 58% of NAV in these top 10 holdings. That's now 63% today, and up from just over 40 going back 6-7 months or so from here. The other point to make, I think, is that despite this increase in concentration, there's still a very diversified asset mix here. So you have Chrysalis, which is essentially late stage venture growth capital, effectively. Gresham House Energy Storage, which is battery storage, Baker Steel Resources, mining and royalties, etc. So you can really see that despite the fact there's fewer names in the portfolio and each one is larger, there's still a very good mix of underlying asset classes there. And finally, I think it bears out the point Charlotte made earlier on that we've reduced the listed equity exposure amongst the portfolio. There's not a single name in there that is in anything other than unlisted alternative private assets. Now, what you'd also find in that top 10 is that there are many of these companies that are either in runoff or we suspect they will go into runoff. What we actually mean by that is that essentially they have committed to make no new investments at all. They will make follow-on investments to protect and enhance the value of their existing holdings, but really any excess cash will find its way back to shareholders at NAV. That's a very key theme in the portfolio. We have 3 names here: VH Global Energy Infrastructure, GCP, asset-backed income, and US solar fund, again from quite disparate parts of the investment trust universe. And the reason why we like a managed runoff is that it's a rare situation where you are guaranteed the discount to NAV is going to zero. You're getting capital back over time at a zero discount to NAV. The key question that we wanted to tackle here is that discount contraction achieved by the share price going up to meet the NAV? Or is it the NAV coming down to meet the share price? Or is it halfway between the two? So a huge amount of our work really is spent trying to validate and interrogate the validity of reported NAVs. Not all NAVs are created equal. Many NAVs are calculated using a discounted cash flow approach with a variety of discount rates, inflation assumptions, cash flow assumptions, asset life assumptions as well. It's really our job, as I say, to interrogate what those assumptions are and to the extent possible, apply our own assumptions and from that come up with a more credible NAV and really assess how genuine that discount to NAV is or isn't in particular cases. What we're really trying to do here across all of these examples is create a range of outcomes where even in our downside case, we may break even, we might lose a small amount, we might make a little amount, but we don't really lose any meaningful amount of capital. And in our base case scenario, we're looking at IRRs of 20% plus, and then the blue sky scenario returns even higher than that. So quite an asymmetric return profile that should all else equal be very much uncorrelated with the mainstream equity benchmarks out there. Another theme in the portfolio is the listed private equity space, where discounts have been extraordinarily wide for a long period of time. You can really divide the funds in this sector into two very broad categories. You have direct funds that will invest in PE funds run by a single manager, names like Oakley Capital, HG, 3i, etc. Then you have the funds that we own here, HarbourVest and Pantheon, that are ultra diversified fund of funds, essentially can be looked at as an index of top quartile general partner managed funds. And the first pushback you get here is often, are the NAVs real? Are the discounts actually real? Our contention here would be that in large part, yes, they are. That's really borne out by the fact that when these vehicles exit investments, that tends to happen at quite large premium to carrying value. Obviously, exits have come down since rates started going up in Q1 2022. So the evidence there is a bit more mixed than it was previously. But in general, exits are still coming at premium to carrying value. And then secondly, and we think even more importantly, there's the ultimate asset test here where there's these days a very active secondary market for PE interest. If you're an endowment or a foundation and you want to reorientate your PE exposure, you can go into that secondary market and trade interests you have in PE funds. Now, what our work shows is that in the case of Pantheon, for example, a large part of their portfolio could be sold at discounts ranging from perhaps 5 to 15% or so. Now, that presents to us a very clear arbitrage where the managers could sell assets at those tight discounts and use those proceeds to buy back their own stock on 30% discounts to NAV today. So it's an area where we are very much involved with active engagement with the boards and managers of these companies to try to make the case to them that there are these fantastic returns on offer simply by acquiring their own stock. Thank you very much.
Cool. I'm back. You didn't have to sit around too long waiting for me, which is good. Brilliant. We've got some questions. Let's start with the sort of big picture stuff first. In terms of what you invest in, is it always just going to be investment companies, or can you stick other things in the mix as well?
So we can invest in investment funds on a global basis. There's a substantial number of them over in the US. Admittedly, the corporate governance is very, very poor. There's a large set of funds, a reasonably large set of funds in Australia. There are Chinese and Canadian closed-end funds as well. And that's certainly an area that you may see over time become more of the portfolio. But right now, the opportunity set is so great in our home market. We don't really see the need to stray outside the borders.
Okay, that all makes sense. And then I think side linked to that, when you look at the portfolio, are you sort of at all concerned that it might not have exposure to some areas of the market that seems to be doing very well? I mean, the question here is about AI. That do you look at it and think, oh, it's a shame we don't have enough in the US, or it's a shame we haven't got more in, I don't know, whatever something you could think of.
Yeah, I mean, I think the fact that, if you're investing in value and discount opportunities, you're not always, in the particularly hot parts of the market. But I think that one of the attractions of MIGO is that, it does zig when markets sag, and sometimes that's obviously not ideal. um, but in other situations, that's something that's very interesting for investors. I think that a lot of investors are quite overweight areas like AI, the US market, etc. And having something in their portfolio that acts as a diversifier, where I think Tom touched it in the wind down slide, is that if assets are sold and cash hand back, if the US market's having a bad day, that we're I wouldn't say we're immune to it, but we're protected from it to a certain extent, because where we're finding returns is a very different area.
And then you've got things in there like Georgia Capital, which obviously very concentrated exposure to one country. As the portfolio gets more concentrated, do you have to worry more about the kind of risk appetite within the fund and where you want to be exposed to things like that?
Yeah, sure. I mean, I suppose what I'd say there is that a benefit of having fewer holdings in the portfolio is having all else equal more time to spend in each of the holdings.
Mm-hmm.
And what we are trying to do is really search out for that asymmetric return profile, where even if we're wrong, as it were, that the downside's limited, and we are genuinely protected by that margin of safety that you get from buying at a large discount to NAV.
I think I'd also add that often, because we're invested in trusts, often the underlying portfolio can be quite diversified themselves. So if you look at something like BH Global, that has a spread of different assets in a spread of different technologies in a spread of different countries, then it does mean that we're not necessarily entirely beholden to whatever the UK regulator wants to do in renewables, for example. And yeah, I think also in the case of Georgia, yes, it's a concentrated portfolio in one country. I suppose that the same could be said for any UK or US fund. And I think if you look at the underlying, I mean, I could talk about Georgia Capital Day, but if you look at the underlying, growth rates in Georgia, they're fantastic, and we're pretty happy to be exposed to a great growing economy with some really great companies that Georgia Capital invested in.
Thank you. Brilliant. So one of the things that people often say about some sectors within the investor company industry is like, well, these things always trade at a discount. It's like a normal state of their existence. Do you buy into that argument, or do you think everything should be trading towards asset value?
I mean, again, I think there's a difference here between where things trade and where you can realise value at, in that there could well be the case in each of the wind-ups that we're in that they spend their entire trading life trading at a discount to NAV. If we're getting capital coming back to us, paid back to us at NAV, then effectively we're getting it back at a zero discount. I think you'll always get certain parts of the market that are in favour and out of favour. I think I would say a lot more generally is that there's very little room for complacency at boards these days. You obviously have Saba, particularly in the equity part of the market. I think their presence both directly in particular funds and just there on the fringes has helped keep discounts narrow. You've seen buybacks at record levels, both in the equity part of the market and the alternatives as well. So I think that if discounts stay too wide for too long and the asset quality is there, you're very likely to see corporate activity in some form or another, be it an activist or perhaps private capital, seeing the value that public markets don't recognise themselves.
So do you think Saba's a good thing overall for the sector?
I would argue I would contend that boards had got very complacent, perhaps, at the time they bought into the sector. They were able to buy it initially, I think, between 15 and high teens discounts to NAV in equity trusts. I think it's shareholders' job to hold boards to account. So I think the more people doing that, the better, I would say.
Fair enough. One of the things we had recently was this attempt to knock together Hickle and Trigg. Are you against the idea of mergers just for the sake of size? Or do you buy into this argument everything's got to be 500, 600, 700 billion market cap?
I think where we sit, for as we sort of said in the presentation, because you've got wealth manager consolidation, they do need improved liquidity. But but mergers that clearly had a considerable amount of backlash is never going to be ideal. I think we commend the boards of Hickle and Trigg for trying to find a solution to wide discounts. And we wouldn't want boards to feel that they shouldn't be looking at solutions. However, I think it's quite clear that the consultation around that merger was lacking. I think lots of people and ourselves would agree that that merger wouldn't have been particularly helpful, particularly to the Hickle side. But if you are, a big trust, or two medium-sized trusts who've got similar portfolios, similar styles, we can see why putting them together and creating a bigger trust with better liquidity makes sense. We do think, however, that there is still a place in the market for small trusts. Yes, bigger wealth managers can't buy them, but that means that smaller wealth managers can, retail can. This is a great opportunity, to be investing in smaller trusts that are giving access to areas that would be very, very difficult to invest in any other structure and in any other size. So something like UK microcap stocks, the closed-end structure is perfect for that. The liquidity is, very poor. There's a lot of value there, and you probably do want a closed-end structure for that. So we don't think that bigger is necessarily always better. We see the argument for it if you've got a liquid portfolio, and it makes sense to improve liquidity for underlying shareholders, but it's not the be all and end all.
Fair enough, thank you. There's a question here about PRS REIT, and I think the point here is that it was sort of a type of being on a discount, and then the solution was to find a buyer for it, and then the buyer sort of offered way below NAV, and the whole thing just got waved through and approved, and the money's coming back now. Is that a good result, or does that shareholders leaping for the cash option too soon when they should have been more patient?
I think you have to look at where the company would be traded in the counterfactual, where there weren't board changes and the company weren't put up for sale. It had traded at persistent discount to NAV for a long time. There were, we would say, valid concerns around governance at the company, the extension of the manager's contract, for example. I think the ultimate outcome was probably disappointing compared to where the reported NAV is. But the particular issue of PRS, it seemed in the end, was that whereas you normally get a portfolio premium effect, and by that I mean that the assets together are worth more than the individual parts, what you had here really was a portfolio discount. It was such a large portfolio that it really limited the universe of potential buyers for the stock in the end.
Yeah, it's interesting that because there was a similar sort of situation with the Phoenix Spray Deutschland, where it was, the portfolio was valued at one thing, but actually every time they sold something, they sold it for a lot more than they're running at. So yeah. Okay, cool. How do you differentiate what MIGO does from what AVI Global does?
Yeah, I'll take that one. So obviously I work on the Global Trust. and take responsibility for the third or so of assets that are in closed-end funds there. The key difference is size, really. With AGT now around £1.3 billion of assets, it does mean that it can't really practically invest in a lot of the smaller trusts in the market. And some of the more interesting opportunities happen to be in that smaller market cap end of the market. MIGO is a pure play on the investment trust market, and we're able to really invest all across the cap spectrum from the very largest to the very smallest funds as well. There's a small overlap of holdings, so both MIGO and AGT have Chrysalis. We both had GCP Infrastructure. We both have HarbourVest. But apart from that, there's not a huge amount of overlap there, and they are quite differentiated portfolios.
Okay, fair enough. Thank you. One of the things that happens quite a lot in sectors, people call for boards to be changed. That's one of the things that Salva's doing at the moment. What's your view generally on where boards are now? Are they generally quite good? And how often do you find yourself thinking this would be a lot better company if only we could change the board?
Yeah, I think that board quality has improved, certainly. I think that, for a long time when lots of trusts, particularly alternative sector, were trading at premiums, you just needed a sort of a steady hand on the ship. There wasn't, an awful lot necessarily for you to do in terms of big sort of corporate stuff. So I think there was a bit of a surprise, and the skill set that you need when trusts are going through a difficult patch is very different. And you do need, people who have the experience of private transactions, and of turning trusts around. We are very engaged with the boards of our underlying companies, and sometimes we think fresh blood is useful, because it's a fresh way of looking at things, or it might be a certain skill set that you'd want to put onto the board. But I think in general, the quality of boards has definitely improved, and we're glad to see it.
Cool. Would you ever requisition something and trying to force something through your meeting?
I think we have quite a good slide on this. So we have gone public in the past, and there's a couple of examples at the top of that iceberg. But I think the iceberg is such a useful metaphor, because the vast majority of what we do in terms of activism engagement is private, and we start in private. We would always prefer to stay private. We want it to be constructive, and work with boards and managers to get the best outcome for shareholders. So we can go public and have done, and I think the fact that we have done is useful, because then boards know that that is something that we can do and are prepared to do. But I think as a team, and we much prefer to do these things in private. Public tends to be when we've got to a stage where the private engagement has broken down for whatever reason.
Cool, thank you. A couple of specific questions that you may or may not want to answer. One is about Innov, the old Woodford Pleasure Capital. Is that something you've looked at, and would you buy it or not?
So we have a very small holding in Innov. I think for that one, you've got kind of a third, and a third of that portfolio. Sort of a third in legacy assets, a third in sort of the venture side, and a third in sort of biotech. Biotech's quite interesting. I think we've seen with trusts like IVT and RTW, you've got bigger healthcare companies coming in and paying premiums, and we've seen a bit of that in Innov as well. You've got a very decent holding in Revolut, which we think is a very good company, and they are holding that at a discount to the last transaction. So obviously that's a very that's a great holding. That's very interesting. But there is a third of legacy assets that are difficult, and so if for us it's a very small holding that we're doing further work on and running further numbers.
Fair enough. Creo is an interesting one, the ground rent income. So, I mean, that it's been sort of a bit of a disaster for a long time. Well, is there sort of value in it now?
Do you want to take that?
Yeah, absolutely. So we think there's still value there. It's obviously been a horrible sector to be in for the last 5 years plus, really now. You may have seen that a new chairperson came in recently, and we are hopeful that Judith McKenzie, who has come in there, will be very additive in terms of skill sets he has in advancing sales talks at the individual assets they've got there, or perhaps for the entire portfolio.
Okay, great. In the renewable sector, what's your sense of where the NAVs are and where they should be? Or is that
Look,
vary by trust?
it's been a very accident-prone sector, we would say, on the whole. And we can understand on that basis alone why HICL shareholders weren't too happy at the idea of taking on things like power price risk, production estimate risk as well. So it's very hard to apply a broad brush approach to analysing the companies there. I think what we would say there is that almost without exception, the board seemed to grasp the net in terms of understanding that the playbook now has got to be try and sell assets at or around NAV, hopefully at premium to NAV, use the proceeds there to pay down expensive short-term debt, and then once you've done that, buy back stock. The problem with a good idea like that is everyone's trying to do it at the same time. So it's definitely a buyer's market at the moment, perhaps even more so now than it was a year or so ago. But in terms of what the plan is, we would agree with that. I think sales we have seen at some of the larger companies have come through at premium to NAV or at NAV itself. There's also some isolated cases where they've come in well below NAV as well. So it really is a market where you've got to be careful and analyse on a trust by trust basis.
Yeah, fair enough. One last question now, I think. Obviously, a lot of what you do is around trying to shrink the supply of shares as a way of managing the supply demand imbalance that creates a discount in the first place. Is there more that companies could and should be doing to improve the demand side?
I think there is more that they should be doing. It's not particularly easy, however. We acknowledge that it's a very tough backdrop. Wealth manager consolidation presents the industry with a real issue there. You know, there are wealth managers out there now who need to deploy £1 billion into an individual fund, and that obviously rules out the majority of the sector on the whole. Cost disclosure has been very, very unhelpful as well, but hopefully we see some positive news there in the coming weeks and months. So we think boards are very focused on that. It's easier said than done, though.
Yeah, fair enough. Brilliant. Thank you very much. Very interesting. And good luck with it all. Obviously, yeah, your interests overlap with mine quite a lot. So, it's a bigger reason to go, yeah. But thank you for your time today, and we'll get you back on again at another time in the future.
Thank
Great.
you.
Thanks
Is
so
the
much.
all-important disclaimer side for everybody should read. And we'll be back next week. And we are actually talking to Simon Barnard from Swiss Investment Trust, even though it will shortly not be an investment trust if all goes to plan. But they were keen to still come on. So I think it'd be interesting to talk to them to find out some of their thinking. So thank you very much for your time today, everybody. And thank you, Andrew. Thank you, Tom and Charlotte. And we will see you next week.
Thanks
Thank
so
you.
much.